Or do you have to kick it off with Equity Mates Investing Podcast now?
Yeah, I think so. I'm going to slightly change it.
Oh, really? What are you going to do?
Yeah, I'll still start with equity mates.
How are you going to change? No, don't tell me. Surprise me.
Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity mates, episode 14. Pumped to be here with you guys again with my equity buddy Ren. As always, how are you, mate?
I'm very good, Equity Mate.
That's good to hear. I hope you guys loved Techtacular last week. We certainly had a ball talking about it. We could have gone on for a lot longer, but we thought we'd keep it nice and short for you. This episode, we're also excited to bring another one of our expert investors. We have an interview lined up for you with a guy called Daniel Want.
Yeah, now Daniel Want probably isn't a household name, but anyone who's looking to get started investing, teach themselves a thing or two, he's definitely someone worth listening to.
Yeah.
He'll tell us his story in the interview, but you'd be hard-pressed to find someone who more fits the title of a self-taught investor.
Yeah, this guy is next level smart, and we had a great time interviewing him. So we hope you enjoy the interview. As always, keep the feedback coming, and we look forward to giving you a wrap on my tour of Italy at our next episode.
Yeah, I can't wait.
Equity out.
Daniel Want is the very definition of a self-taught investor. After dropping out of university with the belief he could teach himself the skills necessary to succeed in finance, Daniel has had a meteoric rise and is now the co-founder and chief investment officer at Prerequisite Capital. Daniel, thank you for joining us.
No worries.
So why don't we start with a little bit about your background? What got you interested in investing, and what were some of the first investments that you ever made?
Yeah, well, probably about 18, 19 years ago, I was at high school, and my business study at high school at the time, I was either going to go into finance and business kind of general direction, or I was probably actually going to go into the Air Force. I realized that I probably wasn't that cut out for a military type culture in terms of order taking and, limited capacities to be able to think for yourself, at least at a lower level, or at least that was my perception at the time. So I chose business and finance. I saw my business studies teacher actually one day played basically a video of this guy who worked from home off his computer, pretty much spent half the day at the beach, and he did this thing called futures trading. And I was kind of sort of, come again, what does this guy do? I was kind of fascinated by that, but this was after I'd already sort of developed an interest in business and even the share market to a low degree as well. Anyway, and so that was kind of the key major sort of domino that fell, that then, set into motion a lot of other things. Out of high school, I grew up south of Coffs Harbour in New South Wales, and out of high school, I wanted to actually get into an investment bank, but they weren't taking people out of high school. And so I ended up in an accounting firm in Sydney while I started a university degree. But it was actually a fantastic experience in that I started in a firm in an audit division and got a fair bit of exposure as well through that time to corporate fraud investigations. So learned a lot about a lot of things pretty quick, and how to read financials and all the nitty-gritty of what happens there, and at the same time obviously doing a degree, or part-time at the time, and found I got pretty sick of accounting pretty quick. Shifted over more into finance, and then thought, well, I should probably try a bit more of economics as well. Economics was a real eye-opener in that I basically, especially in the early subjects, and you would essentially have the professors explain to you why the assumptions underpinning the economics they were teaching you were ridiculous and not necessarily in touch with reality. And that was fair enough, we'd all sort of make jokes about that sort of thing. But then between the first principle, or the first assumptions that underpin at least what we were taught back then in economics, and I don't think it's too much different today, but between the assumption sort of level of teaching and getting more complicated into the higher frameworks, all of a sudden I started to notice the teachers and the lecturers and things going from basically ridiculing the assumptions to actually a quasi-religious belief in these big, complicated frameworks that they then construct. I struggled a lot with that, not so much in understanding the concepts, but just in how is this robust, because if the foundations are still ridiculous, then who cares what you build on top of these things? And pretty quick, I started to learn the hard way that, at least in the institution I was in, they don't necessarily want to think, or even, it seems, construct a better understanding of the world. And, I kind of pretty quickly was left with the impression that, you're actually not supposed to think. You're just supposed to go and read other people's stuff and try and quote them and, write these big bibliographies. And any original thought is kind of taboo, at least in those early levels. But we were still learning about stuff that was more applicable, I thought, to Mars. And so pretty quick I started to realize that, look, if I'm going to have any future in this industry or as an investor or, ideally in time as an investment professional, I can't be learning the stuff that they're trying to teach me because it seems ridiculous and just out of touch with what I was at the time thinking was reality. In the end, I just quit uni. I thought I could do a better job teaching myself than they could. So I basically moved back from Sydney. Everyone thought I was nuts because at that time I was progressing quite a bit in different realms, and especially from a career sense, and starting to do the interviews with the investment banks and all this sort of thing. And I thought, I've got to get back to basics and just try and get schooled somehow. And so I pretty much walked away from all that and went back to the family home back south of Coffs Harbour and spent a few years, must have been a bit over 3 years, as a hermit. And every second week I'd have another box of books rocking up on the doorstep. Fortunately, I with the internet and Amazon, you have a pretty much a global reach. And I'd find a lot of the more interesting and useful books were actually out of print, and I'm having to buy these second-hand things that were printed decades or even half a century ago, even in some cases. And only to find that, the world just doesn't change. It's still run by people, and it's still all the same dynamics. And funnily enough, I've spent over the last 15 years especially a hell of a lot of time trying to understand banking systems and capital flows and all sorts of things in a more intense sort of manner. And especially when it comes to banking systems, surprisingly enough, I probably learnt more from guys that were around like 100 years ago, 200 years ago even, about even how the banking system works today, because the principles are all the same. It's sort of same old stuff, same basic principles. It's just a different sort of technological and regulatory sort of era with a slight, different context from a geopolitical perspective, but same old stuff. And so, nothing that's happening now hasn't really in some way, shape or form happened before, or at least a lot of really smart, switched on people have understood similar dynamics that are happening now back many decades or even a century or so ago, and warned about such times. And so when I quit uni, I basically had two questions I set out with. One, I wanted to figure out how the world works, as you do, and young and naive enough to just have a crack at that, with a view to being able to express or use that understanding of how the world works to being able to navigate investment markets. Now, the second question was actually a little bit more sort of less big picture, but how could I walk into any business and grow it was sort of the second objective. And so running, and I also, in pendulum swinging from the academic university environment, I pretty much resolved, especially in those early days, years, I didn't want to see another textbook. In fact, I didn't really want to learn from anyone who hadn't had a track record of success in whatever field, whether it's business or investing or even anticipating to some degree, future events. And so that was sort of the criteria. I wanted people who were in touch with the real world, who'd actually had demonstrable success in the real world in terms of understanding it, operating within it, and even anticipating it to some degree. And so I didn't know where to start, so I just bought books on everything, and every one I could sort of come across. And so if you'd read a particular guy who was successful in business or investing, and he mentions a certain set of concepts, or some other guy, then you write the concept down, or that guy down, and go through the, anyone he mentions as, in a who he holds or she holds in a high regard, and then track books down on him or her. And and so one book would turn into 5, which would turn into another 20, and it just sort of, things would breed like rabbits. And so in those early days, more or less just trying to learn everything I can about history, psychology, sociology, economics, like what I would more call a real world type economics, finance, banking systems, and business, even marketing, sales, and strategy, and all of this sort of stuff, because everything I learned pretty quick was interrelated. It's very hard to understand one field without having some exposure or loose understanding of another field, or a seemingly unrelated field. In the early days, it was a bit intimidating, because the world just seemed to get more and more complicated the more books you read. You start to realize how much you just don't have a clue, and in some ways you almost feel like stumbling in the dark, and you get a bit overwhelmed. You sort of just keep on chipping away. And
Daniel, at what point did you realize did you feel comfortable then that you'd learnt enough, and what was the next step?
Well, to be honest, I went through a cycle every 3 to 6 months of, because I burnt every bridge, right? And that tends to motivate you pretty strongly, especially when everyone thinks you're nuts. Yeah. And so every 3 to 6 months, I'd go through this cycle where I was just getting blown away at all the different things I was learning. But then, come every 4 months, I'd be like, oh, I've ruined my life, what have I done type thing. But then I'd get perspective and go, no, I'm learning some really fascinating stuff. How can this not be profitable to me in the future? And so you'd keep going. And at the same time, I opened up a futures trading account.
Okay.
Of all things. And fortunately, I'd learned enough about risk management and money management to basically not have a clue what I was doing, but still come out okay, more or less. And so, quite a big sort of roller coaster ride type season, but fortunately I'd grasped a lot of what the old guys were saying, so to speak, or at least in all the different books I was reading about risk management, and it's just so essential. And that stopped me from basically blowing up in those early years of, I look back now and I just like, wow, I just didn't have a clue, really. So that was just absolutely fascinating, and I learned really quickly that just as important as gaining an understanding of the world and markets and risk management, etc., just as important as actually gaining an understanding of yourself and your own psychology and all the mind games that come with it. And when you're on a boom-bust sort of roller coaster ride of, because I figured the only way to learn about investing or trading and things is to just throw yourself in there and start doing it. And that's correct. But in hindsight, I probably wouldn't have risked as much of what I'd saved up leading up to that. But fortunately, the risk management kind of bailed me out. And so I was kind of blown away, actually, by the risk management side of things, in that it was able to preserve any big sort of blows to the money that I'd saved up. And so, had a lot of wins and a lot of potentially larger losses, but I was fortunately able to cut them short pretty quick. And so I learned a lot about the value of risk management in the early days. I just didn't really, or in hindsight, I had no competitive advantage or no really consistent methodology or an edge in what I was doing in trying to actually even operate in those markets. And so it was all pretty random.
So where did the decision come to sort of rejoin the broader financial sector and, put your talents to use?
Well, after a few years of that, one of the other aspects of figuring out how the world worked, that overarching question that I was driving towards, was that I wanted to work out a way to operate in the markets, but in a way where, in theory, what I did wasn't liquidity constrained. Now, what I mean by that is in different markets, there's a certain amount of money and you can actually trade or invest behind certain strategies. So if you are only trading in the smallest, small or micro cap stocks, say on the ASX, and these are the smallest companies that basically sort of trade on the ASX, for example, they basically have no liquidity. So it's kind of hard to buy and sell and all of this sort of thing. And you can usually only buy and sell these stocks using small amounts of money relative to, say, the professional funds management industry or the larger amount of money. And so I knew I wanted to move more in that macro, bigger picture. You know, I was more interested in studying countries rather than companies, so to speak.
Right.
And so after a few years of being the hermit and realizing I had to get back in the real world again, I moved up to Brisbane. I didn't really want to go back to Sydney again. And long story short, I basically typed in, literally into Google, global macro hedge fund, just to see what would come up. And turned out at the time, there was actually a global macro hedge fund that kicked off in Brisbane about a year earlier to when I did it, when I just ran the Google search, so to speak. And I was pretty surprised, but it was founded by an ex-proprietary trader from BT and Macquarie. And, you know, he's at one time there the most profitable FX trader in Australia and all of this sort of stuff. And so he'd had quite a successful career in proprietary trading previous to that. And anyway, so I went to the contact us page and just dialed their generic number and went through to the receptionist. And fortunately, I don't know, she felt sorry for me or something, but I just basically told her, like, look, I want to talk to David, who was the chief investment officer of one of the founding directors of that global macro fund. And I said, look, he doesn't know me. I want to do what he's doing in 10 years. I just wanted to try and call him up and offer to buy him lunch one day, just to pick his brain, so to speak. And anyway, she sort of said, look, leave it with me. And Dave called me back a little bit later that day, and he actually gave me a bit of a grilling, just, you know, who are you, what's the story, and all the rest of it. And I was basically, you know, same old thing. You wouldn't know me from a bar of soap. Can I buy you lunch? And blah, blah, blah. And anyway, he basically agreed to catch up for brekkie a few days later. So we caught up, and I just basically explained everything I'd done and even the analysis that I was doing on the world at that point in time. And by that time, I developed a pretty unique way of looking at the world, mostly through I'd spent a lot of time studying what is essentially known as like complex systems thinking and like complex adaptive systems analysis type methodologies and all of this sort of thing. Mm-hmm. It's a bit of a can of worms, and it's not as complicated as it actually sounds. Anyway, I figured I actually was fortunate enough in a similar manner to reach out to another guy who was in the US, who actually ended up becoming a mentor as well. That he's basically like a world-renowned expert on systems thinking, but as applied to businesses and all of this sort of stuff for performance improvement, etc. And I figured, well, all these methodologies are all just, they arise out of, ironically, quantum physics, even though that sounds complicated, but these principles of systems analysis and thinking actually aren't that complicated. And I thought, well, the ultimate complex system was the world and economics and the financial markets. Let's try and apply some of those concepts to that. And so I'd been doing that for Australia and the US and broadly speaking, the major markets of the world. And so I started to run that through all of that sort of analysis with this chief investment officer. And by the end of brekkie, which ended up being quite a long brekkie, he more or less invited me to up to the office in Brizzy and met the other directors, spent more time talking, and he basically offered me a job as an analyst. And I thought, wow, this is awesome. And I was still in the mentality of, hey, I've got a long way to go. I want to learn rather than earn, you know, in terms of earn money, so to speak. I was still in learning mode. And so I found, you know, I would have paid them or at least done it for free, volunteered to work with them, let alone get paid to do what I loved and to also learn more. Funnily enough, from that experience and that was, you know, sort of leading into, that was in 2007, sort of leading into the GFC in 2008 and all the rest of it that followed on after that. And a lot of that analysis that I did in 2007, especially from that systems perspective, ended up being spot on, and a lot of people were sort of witnessed all of that, and that sort of started to and especially when it all started to unfold more or less to a T in 2008 in the different macro markets. And so because a lot of people kind of had front row seats and were witness to that analysis methodology, and the analysis I'd done in 2007, and then watching everything unfold in 2008, that sort of started to kick me off quite a bit. I started to pick up research and consulting clients and all of this sort of stuff outside of that macro fund as well.
I mean, your journey sounds amazing, and early on, very, you had to absorb a lot of information, do a lot of reading and that sort of stuff. For people that are just beginning to invest and are a bit overawed by all the information and sort of jargon that's out there at the moment, what are some things that you would recommend that they do to get the ball rolling?
Basically, the best thing to do is just try to watch, buy books that are just focused on interviewing investors. So successful investors and traders of all different types, everything from the Warren Buffett type, stock picking, valuation type approach through to currency traders, through to everyone else in between. Now, in a practical sense, a man by the name of Jack Schwager wrote a whole series of books, and every chapter is just another interview with a highly successful investor.
Okay.
Now, he wrote this series of books. It's called Market Wizards. I think he might have started in the early 90s, maybe. I can't remember. But anyway, over the last 20 or 30 years, he's done basically a whole series of more or less very timeless sort of interviews with some fantastic investors and traders of all different types. And the reason I suggest that you probably want to start there, it'll simply expose you to all of the different things that are out there. Because when you start, you don't know what you don't know, and you don't even know what's out there and all the rest of it. Now, there will be a lot of terminology in there, but Jack Schwager does usually, from memory, he's done a good job on like putting a glossary in at the back and explaining the odd term here or there. And so it's a crash course in kind of learning the investment and trading and market type lingo and language that you kind of got to pick up. Every field has its own language, and step number one usually is actually learning what that language is and all the jargon and the mumbo jumbo of what people are actually talking about.
Yeah,
so these interviews are a good crash course in that. And also you're just exposed to everything, because the key to actually becoming a successful investor or trader or whatever it is you want to do in the future is actually finding an approach or a way of operating that is actually more of a natural expression of yourself. So the way you're wired, your personality, what your interests are, what you're interested in, all of this sort of stuff. Because if it's not just a natural expression of who you are and your personality, and then you're not really going to be able to sustainably run whatever it is you're doing, and be interested and passionate enough and curious enough about whatever it is you're doing to actually be successful. Unfortunately, investing and trading, in some respects, it's a bit of an all or nothing type endeavor. You kind of got to throw yourself into a fair bit. However, there are ways of operating and, more basic first principles that you can stick to that will kind of keep you safe. But at the same time, it all just comes down to what are you interested in. By reading books like Jack Schwager's, another set of books that are a little bit more recent, written by someone, his surname is Drobny, Drobny. He tends to interview, I think the two main books are Inside the House of Money and then The Invisible Hands. He tends to interview more like hedge fund type managers and different things, but that's a sort of a more recent version of Jack Schwager's Market Wizard books. Throughout all of them, you kind of get exposed to a lot of different investment methodologies, trading approaches, different markets, all sorts of things. And then once you've sort of absorbed all of them, and plus there's so many timeless principles and lessons and stuff that these very experienced traders and investors share during those interviews, that it's actually a fantastic crash course in everything anyway. Sort of books you'll fill up notepads or whatever it is you like to do in terms of scribbling down principles or precepts or great ideas or interesting ways of looking at things or whatever it is. And they also cover off a lot on the psychology side of things, which is just as important in learning to effectively master yourself and your own, all the head games, mind games that sort of come into play when you start to get involved with investing and markets and all this sort of thing.
Great. I think that's some great advice for all of our listeners who are, unsure of how to start. Reading those books that you suggested, Jack Schwager and Drobny, sound like really, really good places to sort of learn and familiarise themselves with some of the different investing styles out there. So from that, What would you say your investing style, or what are some of the core philosophies that you stick to when you invest? And did that change over time?
Yeah, they've definitely evolved in time. But there was a couple of underlying observations or thoughts that kind of have stuck with me since those early days. One of them, for example, was there's an old quote by I think he's Jack Welch. Basically, he says, "If you don't have a competitive advantage, don't compete." Right now, in business, we intuitively kind of get a sense for that, because without competitive advantages, you don't really have a basis for expecting outsized profits or any profits, quite frankly, because you'll have no bargaining power. You'll be a price taker instead of a price maker in business, et cetera, et cetera. And so I figured that was just as applicable to the markets, which it is. You're trying to develop some sort of array of competitive advantages or some form of an edge that puts the odds in your favor, so to speak. Now, in those early days, I'd actually done a lot of, especially having the accounting background and a little bit of finance as well, I'd done a lot of, say, security analysis or stock, like fundamental type analysis, like a Warren Buffett style type of thing. But more and more I was gravitating towards the bigger picture sort of dynamics and changes and what was happening in the world. And there was two main reasons for that, because when I was doing these, valuation models for pick a company and going through all the financials, I started to realize that you can analyze these businesses till the cows come home, but 60% plus of what actually drives a change in the share market, in the share price of most of these businesses, are actually related to bigger picture, macro level things. And even in the valuation type frameworks and spreadsheets and analysis that I do, you have to put in assumptions for like currencies and interest rates and all sorts of things. And in the general level, you'd have to get a sense for the general level of economic activity and in an economy, depending on what company you're analyzing, to get a sense for, or a forward-looking sense for revenues and all sorts of things. And so I started to realize that, look, you can be fantastic at analyzing the nuts and bolts of these companies, but at the end of the day, one of the biggest drivers of ultimate performance is still, for most stocks, macro level dynamics, these assumptions we make about interest rates and all the rest of it. And so I started to realize that I need to learn a lot more about the macro side of things. The other thing too that I realized from a competitive advantage perspective was that I'm not well connected. I grew up basically in the bush in rural Australia. I hardly knew anyone that invested in stocks, let alone knew what a bond was, or how the currency markets, all of that stuff, right? And so I wasn't exactly going to be privy to like inside information, not that that's legal, but I would never have an edge in terms of information flow from a company-specific type perspective, or at least this was my thinking in the early days, and that's still largely true, more or less. But I also realized that, look, when it came to the bigger picture trends and macro changes and interest rate trends and currency trends and the broader stock market itself and commodities, etc., there actually was no such thing as inside information at that level, at that big picture level. And so I'm like, you kind of, everyone has access to pretty much everything, all the different data sets that are out there, and there's no one data set or piece of knowledge that really will, that you could even class as being material or inside information type thing, because the world is just too big and too complex, and these markets are just too big to basically have to worry about that. So I figured, well, at that bigger macro level, it's more of an even playing field. I can sort of develop some competitive advantages or an edge or a better understanding in certain areas than a lot of the people I'm competing against, or at least that was my thinking, which is more or less true, but I didn't realize, it's a pretty tough game out there. But anyway, and so that drove me more and more towards the macro level stuff as well. And I was interested. I'd always been fascinated about how countries, and societies, would rise and fall and all of this sort of thing, and the bigger picture dynamics around asset markets and booms and busts and all the rest of it. And so that tended to take me towards the bigger picture stuff. And so now what I do more is not so much analyze companies per se, but still my main focus is countries. And so, yeah, I've headed in that bigger picture direction more so than picking stocks.
Can you give us an example then of what things you're specifically investing in when you say, you're following the bigger picture and the macro trends? What assets?
Yeah, okay. So, for example, we run portfolios for our clients, mostly here in Australia. And, when you're analysing even half the companies on the ASX, Australia is such a small aspect of the broader world. I think both from a GDP perspective, so the size of our economy, and also if you were to take the size of our banking system, for example, like our commercial banks, like the Big Four, plus all the rest of them, and our central bank as well, we only come to about 1 to 2% roughly of global GDP and global sort of money and banking assets, for example.
Wow.
And so we really are, and especially the way the world has kind of been configured the last 20 years especially, we're kind of that flea on the monkey's back, and that monkey is more or less China. And there's a symbiotic relationship between China and the US that you really need to get your head around. And so in order to analyze Australia, you really actually need to start with the US and start with China, and then some of the other different things that are happening in the world. And then, after you've probably spent 60% of your time on all of that, then you can start to look at Australia in some form of proper context. And especially because of our linkages with the world. And so we run portfolios. Our main objective is actually to preserve purchasing power. We're trying to actually generate a positive return over any 2-year rolling period. So, For example, when I was back at that hedge fund, starting in 2007 and going through the GFC, we actually did really well. I mean, by the end of 2009, we were starting to win awards because we basically saw it all coming. We were able to make the most of it in the markets, and et cetera, et cetera. But at the same time, I'm like, man, there's a lot of people that got smoked, including my own family and friends, to a large degree as well. And I'm like, we've got to take some of this knowledge that's out there and actually package it in a way where an average person can actually have the benefit of, because it's like these things, like the GFC, for example, in some regards, you can simplistically paint as just history repeating. It's the same sort of cycles, same sort of stuff, but you've got to do your homework to be able to get a little bit of a forward-looking, probabilistic sort of view of things. And so, anyway, 4 years ago, with a few other guys, we founded PCM. And so we basically run mostly superannuation portfolios for people, but we do it in a way. We don't use derivatives. We don't use futures and stuff or options. We don't use leverage. We don't sell short anything, so it's just long only. The only things we use are securities that are traded on the ASX or the New York Stock Exchange. And the reason for that, and even the securities we do use on those two exchanges, are big, boring, highly liquid securities, right? And so what we do is more or less like an asset allocation. We take a dynamic or a slightly active approach to managing the risks that are confronting both the share market, the bond markets, currency markets, precious metals, so gold, etc., and cash. We take a bit of a global view, but our main objective is actually to preserve purchasing power, so capital preservation first. We don't really want any of our investors, and half of our clients are actually family and friends anyway, so we kind of eat what we cook, but we don't want to put people on roller coaster rides, basically, which is the typical experience of most people in superannuation over the last 10 years has just been one heck of a roller coaster ride. I do that. We construct these portfolios using a combination of shares, share market, both domestically and internationally, but only through, simple, boring, big liquid, asset class type ETFs on the ASX and the New York Stock Exchange, depending on whether it's the more conservative or more proactive strategy we're talking about. Bonds, so government bonds, mostly just Australian or US. Now, at different points in time, we'll either be underweight or overweight these different asset classes, right? But when we always maintain a fairly diversified stance that makes our portfolios quite resilient. So whatever happens, something will go down, something will go up, and we should be able to maintain the resiliency of the capital in these portfolios over time, irrespective of what happens. So we have shares, bonds, precious metals, cash, say a little bit, depending on the portfolio, of foreign currency exposure. Like, for example, we might own some US shares, for example, and we'll choose not to hold them on a hedged basis. So we'll get the benefit of, say, the US dollar going up against our Australian dollar falling against the US dollar. But then other times we might choose to hold those US shares or assets on a hedged basis. So we'll neutralize or knock out the currency aspect of the equation. Yeah, that's basically the bulk of what we do. And in order to do that, we use a fairly simple common sense sort of framework that's fairly easy to explain and understand. And we just take a conservatively dynamic but active kind of approach to effectively, if a particular market's going up, whether it's the share market or the bond market or whatever, we'll tend to be overweight that asset class. And if a particular market's going down, like whatever it is, we'll tend to be underweight that asset class. And we just sort of rebalance the portfolios a little bit according to the major trends out there in the world and in the asset markets.
Yeah, right.
And so, it's fairly simple and always liquid and transparent.
So, given your focus on big macro features in the economy and complex systems, would be remiss if we didn't ask you what you thought about the state of the economy at the moment. You turn on the finance news and you can hear everything from the crash is imminent to buy. So do you have anything that you're sort of really paying attention to at the moment, and anything that our listeners should maybe keep a close eye on?
Yeah. First, I just need to touch upon one sort of principle, a bit more of a qualification type principle, but then, I'll basically give a quick summary of what I'm seeing from an economic and then also just a major markets type perspective. So one of the things that I have learnt that you need to do as an investor is not so much try to predict stuff, but try to identify when you need to adapt, right? So you need to watch the way the system or the economy or the markets are evolving and adapting, more so than trying to predict some end game outcome, right? Because you need to stay focused on that process of change rather than any end result that you think might ultimately happen, so to speak, because it is an adaptive system out there. Now, having said that, we're pretty late in the cycle in a lot of things. The only real economy ultimately that has been holding up economic growth in the world has been the US. They're very late in their economic cycle. They're starting to get due for, a recession, even at the most simplistic level of going, well, you normally get a recession every, somewhere between 5 to 10 years. And the US has been going quite a while now since technically they came out of their recession. And so we're kind of just on a time cycle perspective kind of due. Same thing for Australia. We've got so much complacency and so much latent risk in our system. It's quite surprising. We're well overdue for some form of at least some sort of a cyclical kind of washout or, recessionary type conditions in the years to come, no doubt. There's no shortage of risks. People are aware of a lot of the indebtedness story, especially at a household level, but they might be a little less aware of our banks and how unbalanced they basically are. So, for example, if you look around the equivalent types of banks in the world as our own, say Westpac, CBA, and NAB and ANZ and all this sort of thing. A typical commercial bank in the world will typically have maybe 20 to 25% of its lending in the direction or related to property, whereas our big four banks are more in the 60 to 65% of their lending is related to property. And so they're pretty unbalanced. Their Achilles heel on top of that is that they've got exposures to they're pretty dependent still, albeit on a smaller scale than what they were, say, 10 years ago, on wholesale international funding markets. And those wholesale international funding markets have been under pressure and have been basically, there's quite a lot of stress and issues building up and starting to come to the surface in that sort of global banking system and funding market world. I don't know when or if that sort of manifests to more acute problems, say from our Australian banks perspective in the nearer term, but the direction those trends are heading in are not necessarily great. And then on top of, so our household level has got too much debt and somewhat unbalanced. Our banks are unbalanced and have a few Achilles heels that could really cause them some grief. And then on top of that, the Chinese sort of credit cycle has been quite extreme by nearly any standard. And a lot of the analysis we do and have done, we just see so much, the stresses are building in that Chinese system, trying to keep a lid on all the malinvestment and the credit overexpansion that they've had in the last 10 years especially. They were at quite an extreme point 10 years ago, but now they're at a ridiculously extreme point. So in 2007, their entire banking system was roughly about $7 trillion US dollars. When the GFC came in 2008, 2009, they kind of panicked and just opened the floodgates on, and instructed their banks and all the different institutions to just extend credit and debt like there's no tomorrow. And so in the space of like 4 years, they went from a $7 trillion US dollar type size of a banking system to about $30 trillion in about 4 years, which is ridiculous on a whole lot of levels. They're currently at something like $37 trillion US. And so the only reason China has kind of powered ahead in the last 10 years is because they've just been on one hell of a debt binge, and none of what they've done, has any of the hallmarks of sustainability. Mostly all they've been doing the last 4 or 5 years is just trying to kick the can down the road and suppress the risks that are building in their system and the volatility in their system in order to basically keep stability and some measure of growth. But there's only so much debt an economy can take before you start to hit saturation sort of levels. Anyway, those are more or less some of the headwinds that are starting to gather, or the clouds that are starting to gather, that are suggesting that you want to think about concepts of resiliency in your investing over the next 3 years, because I think you're going to probably need it. So is your portfolio resilient? Is your investment selections and activity, you a little bit more focused on diversification and really being a little bit strong on the risk management side of things and the resiliency side of things, more so than, getting on the offense and taking on risk or concentrated risks and all this sort of stuff. So it's sort of, we're coming into seasons where you probably want to be a little bit more defensively minded rather than offensively minded across a whole range of markets.
For beginners, with just off that comment about developing sort of concepts of resiliency, without going into shorting and all that sort of stuff, what sort of strategies can a beginner do? Sell down into greater percentage of cash, or?
Yeah, I mean, basically, you don't necessarily have to. In fact, using derivatives doesn't necessarily make you more resilient. In fact, that can just make you more inflexible and cause a bigger blow up, especially if you're doing it with leverage. And so moving in a direction of the resiliency tends to be more, focusing more on genuine diversification of the different investments and assets that you hold.
Yeah.
So if you've got a portfolio of like 20 stocks, who cares in a problem or a crisis? They're all going to basically behave the same, right?
Yeah.
And so diversify them with different asset classes. So some sort of an allocation to cash, or some sort of a small allocation to, say, precious metals, a small allocation to bonds, for example, or whatever it is. Just start to diversify a little bit so you've got parts of your portfolio that move in different directions to other parts in that portfolio. It's a bit of an oversimplified sort of strategy or approach, to take things to an extreme, just to illustrate the point, for example, there's an old guy who passed away, I think a decade ago. He was by the name of Harry Brown. He wrote a very simple but effective book called The Permanent Portfolio. Now, there's no perfect way of constructing a bulletproof portfolio. It just isn't one. But his approach to just moving in the direction of resiliency was about as least bad as you're going to find type thing. And he basically would say, look, if all you did was just allocate 100% of your portfolio, 25% to cash, 25% to equities, 25% to longer dated government bonds, 25% to precious metals like gold, and then stuck your head in the sand, rebalanced once a year, come hell or high water, you're probably going to preserve your purchasing power most of the time.
Yeah, right.
So the logic was, for growth conditions, that's equities, that's the share market. They do good when everything is going well. For recessions or crisis situations, that's cash. If you have cash when others don't, then you've got an ability to buy high quality assets that have basically been smashed down in price. You get them at bargain basement type prices. Anyway, and then inflation, then simplistically, that's why you hold a bit of gold, for example. And deflation, or longer dated government bonds, tend to do really, really well in disinflation or deflationary type conditions. And so the world is only ever going to morph into some combination of those four conditions. So growth, recession, inflation, or deflation, some combination of them. So his logic was, well, one of those asset classes is going to do okay, another one's going to get smoked, and on balance, it'll all even out and preserve your purchasing power. And, if you look back over the history of markets and, say over the last 30 years in Australia, the last 50, 100 years in the US and 100 years in the UK, that basic allocation approach more or less works. It's about as robust or resilient as you're going to get. The only problem with that approach is that it's a bit of an extreme one in that, sure, you'll be quite resilient and you'll preserve purchasing power, but you're also not going to really generate much return out of the thing. You just keep pace with inflation more often than not. But that's an extreme example of resiliency, for example. And the other benefit of that sort of a portfolio is that it's liquid. You can convert it to cash anytime. One of the things you got to be careful of, especially in this world, is what happens behind a unit price, and managed funds. When things go wrong or surprises happen in the world, then you start to realize that all that fine print that you sign up for in these managed funds, and all you ever see is a unit price, right? I don't know to what degree you've experienced this, but there's all sorts of stuff that happens behind that unit price by way of fees, by way of potential for locking up money and not being able to liquidate or get your money out in different conditions, and all sorts of stuff. It obviously depends on the fund and all of this sort of thing. And so that was one of the other benefits at an extreme example, and I'm not actually recommending that you go and do this, right? This is all just a general discussion of principle, for example.
Yeah.
But Harry Brown's approach, it illustrates the point. And those four asset classes, so cash, equities, bonds, and precious metals, they're about as unrelated to each other as you're going to get.
Right.
There's probably also a small argument for a small degree of, say, foreign currency, just to protect yourself against your domestic currency getting smashed for whatever reason. But that kind of gets into the logic around precious metals as well. And so it's all, but that would be, and in a more practical sense, how do you get more resilient? Well, start to pay down and get out of debt if you can, build up your savings buffers, develop some more competitive advantages, either in your career or your business or whatever. And there's nothing makes you more competitive than, high quality education. And that doesn't necessarily mean going to a university, but learning more, developing a capacity to adapt. It's sort of that capacity to adapt in the midst of adversity that's really what resiliency is all about. So how can you make sure you're not inflexible? Because if you're inflexible in any realm, like you've got too much debt, too little savings, too little income, or income that is vulnerable to disruption, then you're very inflexible, and that's when bad things happen. But if you're flexible, trying to build savings, trying to reduce debt, flexible, kind of resilient income streams or educating yourself to be more attractive to your employer or different employers, different skill sets, or if you're a business owner, how can you, develop different competitive advantages to sort of make sure that, you're the business that's left standing in any adverse, negative, surprise type event, et cetera, et cetera. So thinking about resiliency, not having big, ridiculous overheads, if you're a business owner, or even a person, not living a lifestyle that sort of, you have no breathing space and you're overcommitted and blah, blah, blah. So resiliency is I use this word, but one other way of thinking about it is like when you look at a natural system in the environment or out there in the world, typically the ones that survive and thrive in time typically have the character trait of being 2/3 resilient and 1/3 efficient. All right. And so simplistically, you could say 2/3 defensive and flexible, adaptive, come what may, and 1/3, productive and really efficient in what they do and competitive advantages and all this sort of stuff. And that's probably the right sort of balance. They typically find in nature, if that balance gets skewed in either direction, like say too resilient and not efficient enough, well, they just simply become obsolete and too inefficient, and they just basically die. They cease to exist as a system. And if they're too efficient, too focused on productivity or just whatever it is that system does, and not resilient enough, too inflexible, well, it only takes the next storm and they're basically out of action.
Wow.
And so the balance in nature even seems to be about 2/3 resilient, 1/3 efficient. And so even that translates into our own portfolios. We sort of have that philosophy permeate through most of what we do, both as a business and then running portfolios and even assessing markets. And anyway, you get the point. But yeah, thinking about resiliency would be highly advised, at least for the next 3 to 4 years. And if you've got purchasing power and cash, and we do have a couple of hiccups, and other people who haven't been sort of as prepared and or given thought and action to that concept of resiliency, and they're sort of hurting, or asset markets have a few hiccups, then you've got the liquidity and the cash and the purchasing power still intact to take advantage of all that. And that's the other trick, is that one of the best sort of strategies you can have is knowing full well that every 7 to 10 years, on average, you're going to get some sort of a hiccup in the world, whether it's a recession or a crisis or whatever, or in your country. And so every 7 to 10 years, you know that you're going to have an opportunity to buy high-quality assets cheaply.
Yeah.
And so make sure you're always prepared for that, especially when you're starting to recognize that, we've been, say, 5 to 7, 10 years since we've had the last hiccup. Maybe just by sheer passing of time and there's just the cycle of history, maybe we're getting closer to the next one.
In terms of building this sort of resilience, very simplistically, cash and equities are quite easy. But for our listeners, what are some ways in which what are the easiest ways of buying, say, government bonds or precious metals? Is it as easy as buying stocks through CommSec, or? Yeah,
if you go onto the ASX website, they actually, in different parts of the website, explain what exchange-traded funds, exchange-traded products, and bonds actually trade on the ASX. And so Australian government bonds, for example, if you thought interest rates were going down or you just wanted to diversify a little bit more, and once again, this is not obviously specific advice, right? There's just a general awareness of what's out there. A great starting point is to go to the ASX website and punch in government bonds, and it'll take you to a couple of education pages and prices and what's traded and all of this sort of stuff. The only problem with this, especially because, the idea is that we're talking at a beginner level, is that a little bit of knowledge can be dangerous, right?
Mm-hmm.
And so, I'd still highly recommend you go and find some people who know what they're doing, talk to them, find a qualified advisor, et cetera, although that can be a can of worms. Basically, you want to find out, when you go to any advisor, right, and I'm talking, say, financial planners, especially stockbrokers, number one, figure out how they're actually paid, because, you follow the money, and conflicted incentives, especially financial incentives, will result in most likely conflicted advice, even though it's probably stock standard stuff, but the whole industry is kind of a little bit, I think, a bit warped. Be very careful of people who get paid on a transactional basis, like a stockbroking model. So they make money not by putting you necessarily into the best investments or stocks. They make money by activity, buying and selling stuff. So really if they're going to increase their earnings or go on that next holiday, they need to buy and sell more stuff in their client accounts to get more transactions and commissions, right? And even the financial planning industry kind of has a similar dynamic, or they try to have more safeguards against this, of putting, people in and out of different products, whether they be managed fund products or insurance products or whatever, because they get commissions on the back of all of this. So number one, figure out how these advisors are getting paid, and be very well aware of the fact that there are monetary incentives to the advice that they give you. A lot of these incentives make them look more and more like a used car salesman, more so than a trusted financial advisor. And so, one, follow the money and figure out how they get paid. Two, especially if they're on an investment, from an investment perspective, do they eat their own cooking, or do they just peddle out all this advice to people, but they don't actually have their own money in the same sort of things, or their own family and friends prepared to be put behind what they do, et cetera, et cetera. And so there's no substitute for education and knowledge, but it's full on. It's quite a journey. You got to be committed, and you're going to run down a lot of rabbit holes. And all I'd suggest is that in the early days or the early phases of your education in all these things, just don't risk much when you're putting funds at risk, because you're guaranteed you're going to be learning a whole heap of lessons. And usually when you're learning stuff in markets, it means you're losing money or you're having negative surprises. There's an old saying that in any trade or investment, you will either grow richer or wiser, rarely both together. Right?
Interesting.
There's another old saying that basically says a bull market, so a rising trend in a market, especially a multi-year trend, will make geniuses out of idiots. It's a bit of a harsh way of putting it, but if you just happen to be in the right market at the right time for any reason, and you might have done your 100 pages of analysis, but who cares if it's the wrong analysis, but the thing went up and you made money, well, that's a false sense of security. And there's nothing worse than the thing actually keeps going up and you keep making money on that same strategy, whether it is you don't really know whether what you are doing is legitimate or anchored to reality or not. You're just in a rising tide, and if it's a rising multi-year trend, that can lull a lot of people into a false sense of security, but they're not necessarily learning what really is driving these markets. Property is actually a fantastic example in Australia right now. If you think property markets are driven, especially overall at a country base, if you think they're driven largely by, say, demographics and interest rates, then, my gosh, you've got one hell of a learning curve coming.
Interesting.
And so, we've had a multi-year, even multi-decade rise in property prices, and we've got so many experts out there, it's ridiculous, but most of them don't really understand the dynamics in the broader system that actually goes to underpinning and driving property prices at the bigger picture level. What makes them go up or down over multi-year, multi-decade sort of perspectives. And so we've got a lot of experts out there that are incredibly complacent, that have only ever seen good times. They've never really been through a serious cycle before. And anyone that's basically been involved in property the last 20 years hasn't really seen a serious cycle before. And so, it's a full-on endeavor, this education. And the best way to do it is to do it yourself. But all I'd suggest is be a little bit paranoid about risk and only risk smaller amounts in your beginning phases of your education, because you can guarantee there's a whole world of experience that you haven't got yet, and there's things you're not aware of. But after you've been through a cycle or so, then you can start to gain a bit more confidence, especially if you've kept on educating yourself and seeking out knowledge, etc.
You mentioned the rising property prices there. I'd be interested in your macro view of the world. Do you look at cryptocurrencies or the Bitcoin, or have a view on that?
Yeah, that's not going to be a 2-minute discussion.
Right.
Maybe another time we can open that can of worms. But
in short, you do look at it.
Okay. The 2-minute version, right? If you're going to look at Bitcoin, and this is not advice, right? This is just general observations. You'd probably make the observation that, look, okay, what's my downside risk? Probably 100% over the next 10 years in a negative scenario type outcome for this currency dynamic, right? Or quasi currency, whatever you want to call it. So your risk on the one hand is probably 100%. So, okay, cool. What's your upside? Well, depending on which optimistic scenario you go with, you can be going from, hundreds of percent to thousands of percent sort of upside over 10 to 20 years if we get the rosy scenarios kind of occur. What's the balance of probabilities between the upside of quite a lot, maybe if, a confluence of really positive things kind of happen and we don't get negative surprises? Well, what's that balanced with the downside potentially of, say, anywhere from 50 to 100%? Probably 100%, maybe if we got a negative confluence of surprises or things unfold over the next 10, 20 years. But see, that's enough of a starting point for thinking about, say, Bitcoin, to then go, okay, well, if I have any exposure at all to this Bitcoin story, it's probably going to be really low, because I know my risk over the next 10 years is probably anywhere from, my downside risk is anywhere from 20% down to 100% wiped out, right?
Yeah.
So you're going to tend to scale your exposure to be pretty much to the point where you don't care, or it's not going to matter if you lose it all in the next 10 years, right? But your upside could be substantial depending on what unfolds over the next 10 years, for example. And so maybe as a diversifier, but ridiculously small, you think or look at it in those sorts of terms as a starting point. And so your exposure is going to be really small. As a credible currency, it's kind of not credible, just because it's too volatile. It's not really a store of value yet.
Yeah, right.
You might use it transactionally in the world, so you want to transmit money from here to some other country. It's probably going to be a bit cheaper, more reliable, a bit quicker, whatever, if you use Bitcoin versus half the other ways. But you're only going to use it on a transactional basis, but then convert Bitcoin into some other currency or money or asset that's a bit more stable, right? Because of its volatility, it's not really, it doesn't have that store of value characteristic to it to actually kind of make it a bit more of a credible currency type possibility. Maybe it's just too early on in its journey, but until you start to see this volatility drop a bit, it's not really going to be a credible contender. There's also a can of worms that we open, which would be another discussion around the risk from a governmental point of view around the world. And really, when it comes to Bitcoin, for example, half the story is actually on the blockchain and the infrastructure under it. It's quite phenomenal that will no doubt revolutionize the internal plumbing of financial markets and banks and everything else over the next 10, 20 years. And that's quite phenomenal in its own right. But see, you've got, I think I heard it was the Bank of England, I think it was Bank of China maybe as well, Chinese central bank. I'm pretty sure it was the Bank of England has their own little project to create their own little cryptocurrency and all this sort of stuff. I know the ASX is exploring blockchain quite proactively, and some of our institutions in Australia actually seem to be on the forefront of at least trying to understand it better and its possible uses. But whether it's Bitcoin or some other version of a cryptocurrency, I got no idea. That goes beyond me. But when it comes to just looking at it from an investment lens, well, the first thing I want to get a grasp on, okay, what's my downside risk and what's my upside? Downside clearly is anything from 20 to 100% wiped out, and there's plenty of plausible scenarios that you could see where that would happen over the next 10 years. Upside, well, you've got the usual rosy sort of ridiculously bullish scenario that a lot of the promoters will give you, and I'm sure there's a possible pathway where that could maybe theoretically happen, and in that case your upside is massive.
Massive, yeah.
But at the same time, I've seen so much, read so much, listened to so many more informed people than I am on that particular subject that are, it's still early days. Even for
big
that,
unknown.
Yeah, that's right. And so, I wouldn't exactly attach a huge probability to that big upside scenario playing out. Anyway, but that's the short version way of maybe even starting to think about it. But yeah, it's really a can of worms in its own right.
Yeah, it's very interesting. Very topical at the moment. Yeah.
Well, of course, but the hallmark, you realise that the fact that it is topical means we're probably closer to an intermediate term top.
Yes.
Right? When anything becomes too popular and it's being talked about out in broader society, you know that, well, it's probably the end of at least an intermediate term sort of swing or trend. And so just be a bit cautious on the short to medium term, but who knows?
Yeah, all right. Well, Daniel, we really appreciate you taking the time to chat with us today. I think you've given us and our listeners a lot to think about and some really good starting points to think about where they want to go with their investing journey. If they want to read more about you or hear more of what you have to say, is the best place the Prerequisite website?
Yeah, definitely. So just go to www.prerequisite.com.au. I also, on a quarterly basis, tend to publish our more general audience type client letters, so quarterly client letters, and that will give you a bit of an overview for, loosely what we're seeing in different markets or on the horizon or what's happening. And so that can be one way to just sort of follow along, where I try to write it for a bit of a broader audience. A lot of the other stuff we put out is a bit more on the intense side because we also, besides running portfolios for, say, Australians in superannuation or outside of super, we do a lot of research for international investors. And so, yeah, we have a weird client base in that we just have a full spectrum of everyone, it seems. Right. But the quarterly letters are the more absorbable, easier to understand ones.
Perfect. And they're published.
That are a bit more Australian focused.
Yeah, great. And they can be found on the Prerequisite website as well?
Yeah. Just go to the website and then on the Managed Portfolio tab up the top, click on that and you'll find our quarterly reports. And it also just talks a bit about how we approach running portfolios as well.
Perfect. Well, yeah, thanks, Daniel. We really appreciate you taking the time and thanks for all your advice.
Yeah, not a problem.
Yeah, thank you. Hopefully we'll do a follow-up on the Bitcoin and blockchain at some point.
Yeah.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.